Hello, my lovelies. Welcome back to True Talk Tuesday, where I give you the real deal on real estate. I am super stinking excited about tonight's guest. We have Julie Surface with South State Bank here in Lakeland. She's with us to talk about credit and how it affects our loans and our approvals, and what do we need to pay off possibly first. So I am super excited that she's going to get to join us, and I am not going to delay that. Hey, Julie, how are you?
Hey guys, thanks so much for having me tonight. I'm really honored to be part of this.
Not a problem, not a problem. I after talking to you the other day, we were at an event at Lakeland Association of Realtors, and after talking to her the other day, I was like, I have to have you on the show. Will you please? Like I begged. Okay, guys, I begged, but she was kind enough to say yes. Julie's a very very busy person, so I am very thankful that she made time for us tonight. Julie, can you give us a little bit about yourself so that way people know who you are?
Yeah, so I am a Florida native. You don't find many of us
Not
around
at all.
town very often, but I am a native Floridian. I live here locally in Lakeland. I am a mother of two, and I have been in this industry for almost 21 years. So I've been through a lot of ups
She
and
started when she was
downs and
12.
that roller coaster. So, yeah, I started when I was 12.
Yeah,
Don't tell
that's right.
nobody.
She started when she was
Um,
12.
but, but I am really grateful to be here tonight and I'm super excited. So let's get this party started.
I know, right? All right. So if you're first time here, again, my name is Shalisa Muehlberger. I am an agent, a real estate agent, realtor with S&D Real Estate Services here in
Yes,
Lakeland,
sure.
Florida. That's right. I'm a realtor. All right. I'm
The
not just
pronunciation is important there.
Oh, look, my first year in real estate, I was again, you said Florida native, right? I was born and raised here in Florida. There's certain words that just come hard to us, all right? Like
Yes,
crayon, right? Crayon is a hard
it's
word for me.
raining.
It's crown, right? It's crown,
Right.
right?
It's
It's like
rain.
it's yeah, exactly. You just say it real fast. Yeah. And
And we only drink sweet tea.
that's it. That's it. No, I needed we went to a barbecue place up north and I was like, I took this sip of tea and I looked at my husband, I said, "This barbecue is gonna be crap." And he's like, "How do you know?" I was like, "'Cause this tea is."
That's
Not
funny. That's
thinking.
funny. I love
All
it.
right. So Julie and I will obviously get off topic very easily. So we're gonna keep
Yes.
on topic, right? So Julie, talk to us about how important credit is when getting a loan and how does it affect us? I know that we're all individuals and everything is going to be out individually based on our own circumstances, but in general, what does credit do to our approval process?
So credit is probably, I would say credit is your ultimate criteria for qualifying for a loan. It is the most sacred thing that a human being should take into consideration in their lives. Literally, your credit is everything. Um, it is so important. It determines program opportunities, it determines rate opportunities. It can disqualify you from many programs. So it is literally the holy grail of your financial future, really. And
Right.
it is so important, so important to monitor it with every ounce of just cuddling it. It's almost like a little baby. You got to take care of it, right? You got to
Right,
feed
right.
it, you got to check its diaper, you got to do all that stuff.
So what are those
And
things?
yeah, it is a real life thing. And it is so important because credit will follow you for 7 years. You
Mhm.
make one mistake and it will follow you long term. Um, and that's one thing that we'll kind of get into a little bit later too, is like if you make a mistake, how long does it follow you? So we
Right.
have a lot of great topics that we're going to follow tonight, and I'm super excited to kind of dive into those. Do you have a specific question that you want to address first?
No, I am anxious to hear what you have to say because you are the expert in this field. I will absolutely be 100 completely transparent. There are things that even though I've been in real estate for a while and I deal with really great lenders such as yourself, right? I still as an agent don't know those things because I'm not dealing with it every single day. I'm dealing with more of the, you know, the inspections and the negotiations of price and things that way. So
Right.
I don't know what I don't know. So I want to hear from you. What do we need to know about credit?
Okay, so most people say, well, how can I raise my score the fastest? What's the best way for me to raise my credit score? Ultimately, making your payments on time is 100% the top line item of raising your credit score and keeping it high. So making your payments on time. A way to kind of boost your score pretty quickly is going to be paying off revolving debt. Revolving debt is lines of credit, most frequently known as credit cards. Woo! How many people's got credit cards out there? I do. I use it pretty frequently.
Mhm.
The key to credit card debt is keeping your utilization ratio down low. The moment that you go over a 30% utilization of your credit limit, that negatively impacts your credit score. So the credit bureaus go, hey, wait, maybe there's a problem here. He's gone over that limit, their total utilization of revolving credit past 30%. Once you reach that threshold, it starts to tank your credit score. So I really recommend that my clients use anywhere from 10 to 30% of what's available to them.
Okay.
Credit cards are not meant to be long term vehicles of financing. It really is just a short term use it, pay it off, use it, pay it off. And that really is your best route to boost your scores the fastest. If you're overextended or you're past that 30% credit ratio utilization, that start pounding some payments to that number and get that number down within probably 15 to 20 days, because creditors report to the credit bureaus on different patterns too. So
Okay.
sometimes those credit reports can take time to update. And so usually you're going to start to see an improvement of your scores within 20 days of you paying something off.
Okay.
Um, I see a lot of folks come to me and be like, Julie, hey, Credit Karma says that my score is 720.
Yeah.
Okay, here comes Credit Karma in. That is a great baseline to monitor your score, but Credit Karma is using a scoring model that is based off of a consumer business line. When you're applying for a mortgage, we are looking at a more restrictive scoring model than what Credit Karma is using. So what I find is clients will come to me and be like, "Yeah, Credit Karma said I'm good. I'm at 720. Let's do this." Okay, great. We're going to pull it. Usually those scores are anywhere from 20 to 50 and sometimes even larger numbers lower than what Credit Karma is telling you as far as your credit scores are. So, Credit Karma is a great way to monitor, but it is not something that you should base your credit score off of.
Okay.
They
Okay.
just they use a consumer scoring model, and
Okay.
mortgage credit scores are more restrictive. They use specific FICO scoring models, and we can get into that in another conversation. I didn't bring any of that specific information with me tonight, but um, usually paying down your revolving credit is really going to get you the biggest boost the fastest.
Okay.
So that kind of takes into consideration of that.
Is
Obviously, go ahead.
is there any specific way that you would say prefer to check your credit as opposed to Credit Karma? Is there a certain app that they should be using or
Not a really specific app, but I would go directly to the Bureau websites.
okay.
And that's going to give you the most consistent information. Now, I don't know if everybody knows this, but by law, you are entitled to a copy of your credit report from each one of the credit bureaus annually. So the way that I use this program is I go to annualcreditreport.com. Shout out. And I log in, say January, and I'll pull my TransUnion report. So, okay, if I can only pull each one once a year,
Yeah.
I'm going to wait 4 months and I'm going to pull a different bureau. So I pulled TransUnion in January. I'm going to fast forward to May and I'm going to pull Experian. I'm going to review those reports. You can dispute information that you find is incorrect right there on their website.
Mm-hmm.
4 months later, I'm going to be pulling the credit report from the last bureau, which is, let's see, TransUnion, Experian, Equifax. And so you can see if you've disputed something, you can see if those items have been corrected, and it'll flow from if you reported disputed on one bureau, it will dispute on all three.
Okay.
So you don't have to go to each website and do it individually to dispute something that's incorrect. But annualcreditreport.com is a great website. You do have to set up an account. There is no annual fee. And if you do go out there and you're kind of like, okay, I pulled this report, but I have no idea what any of this means because let's say I get it. It
Yeah.
is like another language when you're looking at these
Yes.
reports. And it can be very confusing. So I would be happy to sit down and review a report with anyone that says, hey, I saw your live feed with Jalissa. And say, hey, this is what we are looking at here and give some suggestions on what we can do. But that's a great way to monitor it.
I have her info in the description for tonight, by the way. So if you're hearing this and you really do want to sit down with Julie, her information is in the description. You can give her a call. Her email is there as well. So
Yeah. So, like credit limit increases. Let's talk about that for a second. Like, you've got your credit cards out there, your creditor says, hey, we want to increase your credit limit. That is a great thing.
okay.
So, because what it does is it increases the amount of credit that you have available, which would then decrease your utilization without you having to do anything. And that automatically is going to improve things for you. Um, Again, ultimately making payments on time is going to be the your biggest factor in your credit history. Now, I get it. We all have things that come up. I just recently had a pet I had to take to the emergency vet. It was a huge unexpected expense that I wasn't planning for. But if you have to be late on something, never, ever, ever be past 30 days because that right there will drop your score 100 points, boom, just like that. And even if you're late just one time in a 12-month rolling history, it takes almost 2 years to get back to that 100% ratio. If you don't miss any other payments and you've done everything perfectly, you probably are only going to get back to maybe 95% of what your score was before you had that late pay. So every time that you have a late payment and you get that 30-day delinquency on your credit report, you are really just delaying the impact of the score's improvement. So, and if you get a 60-day late pay or 90-day, ooh, that just makes matters even worse. It gets really hard at that point to come back from something. And I get it. You know, there's times that things get tough and I got to pay a late charge. Okay, I'm going to pay a late charge, but don't ever go past 30
Yeah.
days. Find a way to make that minimum payment regardless.
I actually had a client, a buyer, lose their approval midway through the contract because they had a 30-day late. And
Yeah, and
it
that's
cost
so
everything.
tough
Yeah. I was like, oh my gosh.
because it automatically just drops that credit score, you know? It automatically drops that score and it's a big hit that first
Yeah.
time.
Yeah.
You know, it really, and it doesn't just bounce back the next month. It takes a long time to recoup from those late pays. So, yeah, absolutely. Um, Another way to kind of increase your credit scores is having different different credit, like for example, an installment loan and car loan versus just having credit cards out there. When you can show the credit bureaus that you can manage different types of credit history, that really goes a long way of building up your credit. So, your scores are made up of different variations of your credit. For example, the length of your credit, that history that you have. So you'll see seniors, this is a great example. Seniors typically always have great credit scores, right? I don't know if you found, well, you may not have found this, but seniors usually have very good credit scores. And the
Yeah.
reason being is because they have a very long credit history. That's why it's so important when you're just establishing credit to make sure that everything is paid on time,
Mm.
because that does impact the credit score as well. Your credit score is kind of based off of different categories. So 35% essentially is your credit history. Hey, that's if I'm paying my bills on time, I'm not having any late pays, things like that. 30% is based off the amount that you owe. So between those two items, those are big. That weighs a lot. I mean, that's gonna like really tilt, the pendulum one way or the other. And in this industry, realistically, I know they say, hey, 680 is a great credit score, but really, truly, you need to be in the sevens. We need to be at a 720 credit score to really say, hey, I've got great credit. That's really kind of the cutoff of some different loan programs of where you go with conventional or whether you go with an FHA loan.
Right.
So credit, the mix of the credit that you have on your report really does impact your scores as well.
Right. And we've learned in this channel before, we've talked about how the different programs, right? The
Yeah.
conventional versus FHA versus VA,
Oh yeah.
they all have their own interest rates. And so some of those that are helping you might have a higher interest rate than like a conventional loan where you're coming in and basically saying, I don't need your help. I just need the help of, give me a loan. That's pretty much it, right?
Right. And 720 tends to be, at least in this market that we're in right now, 720 kind of is that threshold of whether we go with one program or another. Because let's face it, most clients don't come in and say, hey, I've got 20% to put down on my
Right.
mortgage purchase, right? That
Right.
doesn't happen.
It
That
doesn't
just
happen.
doesn't happen unless grandma has recently passed and she left you a crap load of money. It just
Right.
doesn't
Or
happen.
they're selling a house.
Or they're selling outs,
Yeah.
right? So usually you're coming in with a minimum deposit. And so when you're looking at that, you have what's called PMI. Well, your credit score impacts how much that PMI cost is. And also, so that's where I like to come in and do a comparison of loan programs for my clients. I'll say, okay, Joe Schmo, you're at 680. So if we went with this program, you're at this interest rate. If we go with this program, you're going to be at this interest rate. And so we just kind of categorize everything and line by line go through it. And that way they can make the decision on what's going to be best for them. But what I find is anytime that you're lower than that 720 threshold, you're going to be looking at that FHA loan.
Yeah.
Ultimately, what that means is you're going to end up refinancing in the future and you're paying a insurance premium for some time that you may not need to do. Now, don't get me wrong. My very first mortgage was an FHA loan and I
Right.
held it for 8 years. There's no shame in the game, none whatsoever. That's what the program is there for. It's very lax in its underwriting, and that credit score helps.
Right.
But you're always going to get a better interest rate the higher that your credit scores are.
What is something that, because I work with a lot of first-time home buyers and a lot of young first-time home buyers who might not have that 720 credit score. We're looking
Right?
at like 620, right? Instead of
Yeah.
the 720.
Mhm.
So what would you suggest to those that are under 600 and they're trying to just desperately get to that 620.
Yeah.
What you would suggest paying off the
Oh,
revolving
yeah.
accounts? Okay.
Yeah, down to like maybe a 10% utilization. So if you've got $1,000 credit limit, let's take it down to $100 balance.
Okay.
You're going to see those scores, excuse me, you're going to see those scores bounce pretty quickly.
Okay.
That's again the fastest way that you're usually going to see those scores rebound. And again, credit cards are not meant to carry debt for long periods of time. They are really used for short term purchases. You use it, you pay it off. You use it, you pay it off. And that helps keep your credit utilization down.
Right. So, okay. All right then. Because I always have first time home buyers come to me and they are young and I get it because I was
Yeah.
in their position, right? I
And
was
it's
divorced at the age
hard.
of 21. So
Right.
I
And with
get
part of your credit score being made up of the length of time that you've had credit, it's kind of not fair because,
right.
granny and grandpa have had credit for 50 years and
Right.
but you've only had credit for 2 years. And so you feel like you're being penalized for having such a short term. And that's why it's so important to constantly and consistently make those payments on time and pay more than what you owe. Paying that, keeping that revolving credit utilization down is really going to be a key to keeping those scores up.
Okay. Okay. So what I'm hearing, and I'm going to reiterate so that way everybody
Sure.
understands. If you are wanting to improve your credit score, absolutely get your revolving credit accounts down to like 10% utilization. Uh,
Yes.
all right. And if you are a younger person, you also need to differentiate the type of credit you have. Get a
Yes.
credit card and a car payment, correct?
Mhm. Yes.
And
Yes.
go from there. Okay.
And go from there. Now, and I have seen where, parents will authorize their child to be an authorized user on their credit. Hey, and
Right.
that's great. That's really great until mom misses or dad misses that payment. And
Yeah.
guess what? Now you've got a late pay.
Right.
Now it's negative on your credit. So what you do is you go back to mom and dad and say, "Hey, listen, I love you and I truly appreciate everything that you've done for me, but can you remove me as an authorized user on your card?" Now they've got to call the card company and go through all of that. But once you're removed, because technically, as an authorized user, you're not responsible for that payment. But if you're an authorized user, it's showing up on your credit.
Right.
So that history is going to impact your scores as well. So you got to be careful about who you're asking to say, "Help me out."
Right.
Uh, um, you have to be on top of that credit. Like I said, it is the holy grail of you buying a mortgage in the future. So it's not that it can't be done, but it is so important from now until you're 80. It is going to follow you. What you do today is going to impact you 7 years from now. And that, unfortunately, is just the truth of it. Collection accounts, we hear about collection accounts all the time. Medical collections, oh, I didn't even know that was I've never got a bill for that, is what I hear all the time. And I get it. I'm a victim of that too. I applied one time for something and they're like, "Oh, well, did you know that you have this medical collection out there and your score is X?" And I'm like, "What? Where did this? I never even got a bill. How was I supposed to know I owed this money?"
Right.
So it is so important to keep up with your credit and using a credit monitoring program. A lot of credit cards have that as an added benefit.
Right. Right.
So if you've got, yeah, so if you've got a card like, I'm not going to shout out to Capital One, but Capital One or um yeah, exactly. So, but there are cards out there that give you your credit report, your credit score monthly for free. Totally take advantage of it. Seriously, that's a great way to monitor what's happening positively or negatively for your credit.
We have a question from a viewer. They want to know, are medical collections reporting or not to the bureaus?
So they are reporting to the credit bureaus. But there is a dollar amount limit. Usually
Okay.
if it's 500 or less, it is not reported to the credit bureaus now. If it is over that threshold, it will be reported and it does negatively impact your credit score. So um I see that is probably that and student loans. Oh, Lord.
You're talking to me. I got both, right? Now, when I refinanced it, I don't know if it was just that I had such great credit that it ignored my medical bills and my student loans, but like I have substantial student loans. I went to school for a bachelor's degree in education and then I went and got my master's degree in literature. So I have I have some student loans.
Yeah, there's lots of folks out there. I totally get that. And unfortunately what happened too with the care when we went to COVID,
Mhm.
all of those student loan payments got put on forbearance, right?
Yes.
And then after I think it was President Biden came in and said, okay, that period is over. We're going to start making you make payments. Unfortunately, a lot of people
Yeah.
who just didn't know, but they now got zapped and show that they're like 90 days past due on student loans. And what does that do? And you don't just have one student loan, you
No.
have 5 or 10
Yeah.
student loans. And when every one of those student loans start to show that you're 90 days past due, man, that is a
Yeah.
that's like
It's
the
a
atomic
nightmare.
bomb going off on your credit report. That is like, boom, you have just blown up.
Yeah.
And it's unfortunate because a lot of times you really can't do anything about that. You just kind of have to wait that 7 years out. But we can always talk about ways to rebuild credit too.
Right. I think that's what we're gonna do next time we have you on because we are getting close to the end of the night here. So I am definitely gonna have Julie on again, and we are gonna talk about a few things. I would love if you are watching this after the fact, I would love for you to leave me a comment of the things that you would like Julie to talk about because
Yeah.
she does really well about talking about credit, and I want her on here again so that way we can help you guys because that's ultimately why both of us do these jobs is that we like to help people.
I love working with home buyers. They want to have a place to call their own.
No.
Put that plant up in the front where if you're a renter, there's a lot of things you can't do to a home. When you want to make it your own in your own space, it's important to feel that comfort. And that's what I'm here for. Sometimes it takes a while to get where a client needs to be in order to make an offer and to be able to make start to make progress on that home ownership key. I've been working with buyers. I actually am so excited. I do have to tell you this. I've been working with some home buyers for over a year now. They have struggled with their credit. And yesterday, I issued them a pre approval letter. I know, I'm so
So
excited.
excited.
And they are eligible for some down payment assistance because they were able to get their scores up high enough.
Oh my gosh, that's
And
awesome.
that's another program we can do too, down payment assistance, because there's
Yeah,
so many things about that.
yeah.
But they are looking at possibly getting $17,000 in down payment assistance that could be forgiven after 5 years.
Oh my gosh, that is,
Yes.
like, remarkable,
So
and it's
that takes them from one price point to another price point, which really could help them in their, I mean, it's a family of seven, so it's a crowded house. So they need the extra space, but this is going to be huge for them. And I'm so excited to help them. But it's a lot of hard work. They have worked hard, they have followed direction, and nothing happens overnight when you're trying to rebuild credit. That is why it is so important to kind of keep a monitor on that. But I'm here and I'm excited to help. And thank you so much again for having me tonight.
thank you for joining. I appreciate you being here and educating my viewers because, like, this is the whole reason why I do this channel is I honestly feel like people need to know what they're going to get into and what to
Yes.
expect. I think there are a lot of people that get the wrong impression from different social media accounts that try to
Yes.
sell them, this dream that, oh, you can have zero down, and that's not necessarily like the way that the things work all the time. Um,
Right.
so
There's other things that play a part in that.
right. I do have one more question.
Okay.
In response to debt consolidation, what are these programs that advise people to not pay their credit cards while they're going through a consolidation?
Okay, so ultimately what you're doing is you're destroying your credit by not paying your credit because your credit cards or not making minimum payments at least.
Yeah.
But what that does is when these creditor companies say, "Hey, don't make your payment," what they're doing is going back to that creditor. And I'm just going to use Discover credit card as an example. So once you reach like three times past due, then that creditor is more apt to work with you on paying off that balance for less than what's owed. But now you have late pays that have drastically impacted your credit score. So I would advise tremendously not to do that. I
Okay.
would call those creditors individually. So if you're in that situation, give me a call. Let's talk through that first. But in typical what situation that relates to is that path that it goes down is that creditor is going to contact, or that vendor is going to contact each one of those creditors and say, "Hey, my client is struggling. They'll settle with you for less than the balance owed." And that creditor may say, "Okay, well, I'll accept that payment plan," but you're paying someone else to make a payment to that creditor for you instead of you doing it directly. So if you can work out a payment plan with that creditor directly, it will always behoove you um, in that aspect because you're talking directly versus using a third party vendor who's charging you a fee to
Yeah.
do it to do it for you, in which you could easily just pick up the phone and say, "Hey, listen, I am in this situation, I need some help. Can we please work out, either you close out my account, let's work out a payment plan." But before you go down that aspect of having a credit consolation or credit consolidation company work with you on something, please reach out. I'd be happy to kind of, let's look at your credit and let's work through a process.
Okay. So see, guys, again, her information is in the bottom of this description. So go find Julie's information, and if you need her to go over things with you, she absolutely will. So like I said, I love Julie. I absolutely love her. So thank you, Julie, very, very much for being a guest tonight. And
Yes.
again, feel free to leave a comment if you need. I answer all the comments even after the fact. Um, Ooh, excuse me. Sorry, I almost had my breath taken away. It was such a good experience. My breath
I
is taken
know. I'm
away.
just so awesome. No, I'm just kidding.
You are awesome. Come on, don't
There's
think
so
you're kidding.
much
You
more
are.
information to share though with your viewers that
Yes,
I'm really excited. And we'll do this again for sure.
absolutely, absolutely. So leave us, a comment. Tell us what you want to hear Julie talk about next time, and we will get it answered for next time. Until next week, when I see you again. And next week, I do have another special guest. I want to say I wanna say it's Check Twice Inspections. We actually have an inspector coming on for next week,
Oh,
so
nice.
bring your inspection
Great.
questions. But next week, I will see you guys again, same time, Tuesday, 8 p.m. And until next time, my lovelies, be happy, be safe, and know that I love you. Because if people can hate for no reason, I can love for no reason. All right? All right. Thanks again, Julie.
Thanks. Bye bye.
Bye.